Hello everyone, welcome to this month's monthly market update. I'm Tyson Romanick, Senior Portfolio Manager here at Baker Boyer, and I'm joined today with John Cunnison, Chief Investment Officer. As usual, there's a lot to talk about, but I think today we'll start off with rates.
Right, and rates are incredibly important, especially right now with all that's going on with the Fed and inflation. So, the key to in thinking about interest rates is just the impact that interest rates can have, both actual movements in interest rates and just expectations for future changes in interest rates, but the impacts that they can have on economic growth, but also on the pricing of financial assets. And we saw that very clearly in 2022, of course, and that's when the Fed, in fighting inflation, increased interest rates from basically 0 to over 5%. When they did that, stocks and bonds fell simultaneously and really increased people's, forecasts for a recession. Now, it's the most forecast recession, I think, in the history of the world that actually never materialized. So here we are, pretty good growth. We've got a labor market that's very strong. We've got inflation that's come down from over 9% to where we are today, closer to 3%. But herein lies the rub, right? So we've gotten down to about 3%, still growing, still pretty strong. But that decline in the pace of inflation, that decline has begun to slow. And I think that's caused a real reassessment, especially year to date, a reassessment of what's the likely future changes in interest rates. And that's caused changes to the market environment.
Right, so for the significant part of last year, markets were expecting 6 rate cuts, a quarter point each, and that would have brought it down to below 4. And the Fed was even saying, they're probably forecasting, about 3 cuts last year. But, right now, due to the, slowing pace of the decrease in inflation, things have kind of changed. And even now, some people are predicting that rates could go up from here. So this chart shows pretty well the reassessment of markets. You can see, the bottom line. This is interest rates about a month ago, from 1 month all the way out to 30 years, and you can see how much those rates have moved up, in just a month, and so a lot of that now is being priced in.
Okay, so with that movement in interest rates and this sort of changing of the sort of assessment for future interest rate changes, what the Fed is going to do, I guess the question on the table for anybody watching is, what does this mean for my investments?
I don't know, John, what does it mean?
I asked you first.
Fair enough. Well, from an economic perspective, on the challenge side, it means that inflation is proving to be a little bit more difficult than both the Fed and the markets thought or were hoping for. And this shouldn't be a huge surprise to anybody. We've been saying for quite some time that last mile is going to be difficult from 3 down to 2. Right. But the good news is we've come down quite a bit. Rates peaked at, or inflation peaked at about 9. We're down to 3, and the fact we're not in a recession is actually pretty amazing. So the Fed actually just yesterday met, and they didn't decrease rates, and they thought that where the economy is at right now could support that.
Right. So bad news on inflation, but the good news is we can hold rates higher, and we're not in a recession, growing still. So then how do we think about investments? So stocks, bonds, real assets.
Yeah, so starting with stocks, there's this narrative out there that high rates are bad for stocks, low rates are good. And if you look at the data, it's basically doesn't support that. There's a lot of reasons why stocks might be going up in a high rate environment.
Or rates might be going up.
Or
stocks go up during a rising
rate environment. Right. And that's just because we have a hot economy. The Fed's raising rates to cool off the economy, but a hot economy is usually means that, companies are doing well, right. Earnings are going up, and that's good for stocks. And so stocks go up and when rates go up.
And we're right in the middle of earnings seasons now, and
right.
we've seen some strong reports.
And so, stock returns have been pretty good recently. Bond side, that's a little bit more complicated. Basically, rising rates are bad for bonds, or at least the bonds that you hold. The good news is that new bonds are being issued at even better rates. Right. So that's I guess a good thing for bonds. The other thing to remember is that right now the bonds, the return doesn't look that great, but if you kind of zoom out, where we're at right now isn't a bad spot at all. This chart up here shows that if we get a 1% increase in rates or a 1% decrease in rates, the returns from bonds aren't the same. So if we get a 1% decrease in rates, returns will go up a lot more than if we get a 1% increase in rates. The returns actually won't go down as much. So it's asymmetrical payoff in favor of the investor.
Right. So like kind of the odds are stacked in your favor as a bond investor today, even though it hasn't felt that great to hold bonds for a little while.
Right.
Right. And on the real asset front, we just increased our allocations to real assets. We did that with the idea that in the middle of the last year, nobody thought that rates would stay flat in 2024 or go up. I mean, that was sort of off the table. In fact, the market was pricing in 6 quarter-point decreases. The Fed thought there would be 3 quarter-point decreases in rates. No one thought it would go up. And I remember at the time, you and I had long conversations, and Ted, talking about how improbable it was that we would see 6 decreases. And we just thought that the probability that we would actually see rates go up, or that inflation would be a little stickier, we thought that probability was one that was being overly discounted by the market. So we thought it was a good time to increase our real asset exposure. Now we're not forecasting the direction of interest rates. We're just simply thinking about the probabilities of outcomes. This was, in our minds, a material one. We allocated to real assets, and it's been a good move, at least year to date. So
yeah, I mean, our real asset allocation has done really well. It's up 3% over the last 3 months, and basically has done what we thought it was going to do in kind of a higher for longer scenario.
Right. Well, always lots to think about with rate movements and the Fed. So
yeah. Well, John, thanks for joining me today, and thank you all for watching the video. We hope to see you again next month. And as always, if you have any questions, please reach out to your Baker Boyer representative. Thank you.
Thanks.